Okay, we're going to go ahead and get started since my clock shows it's a couple minutes past 10 o'clock. At the outset, I have a couple housekeeping items. First of all, we are recording this presentation and we'll be making a recording available later in the week or early next week. So if you want to listen to it again or share it with any colleagues that you may have, we'll be publishing that and sending the link to the recording out to everybody following this. We'll also be sending out a link to the slide deck as well, so that will be available to everybody. To keep the volume in check, we do have everybody on mute so we don't pick up any background noise. We will have an opportunity at the end to take any questions you may have. There's also an ability on the GoToWebinar panel to submit any questions that you have, and we'll try to address those either as we go through the presentation or at the end, or if we need to, we can follow up and speak directly on any of those questions. Wanted to start out by just introducing myself. As I mentioned, my name is Scott Cameron. I'm the Chief Investment Officer for Multnomah Group and a principal of the firm. In my role, I oversee all of our investment research, which includes investment research on target date fund strategies, and meet regularly with investment managers offering target date fund strategies that may be of use by our clients. Our agenda today is to talk kind of broadly about what we think is the prudent process for evaluating target date funds. And we're going to start by providing a little bit of context of why this is such an important issue, looking more broadly at the set of choices that are available to us as qualified default investment alternatives and what that means. Provide a little bit of context about where the market is for target date funds today. And some recent, in the past couple years, guidance that we've seen from the Department of Labor on target date funds. After that, we'll kind of walk through what we think is the process, prudent process for understanding and selecting these types of products for your plan, as well as from an ongoing evaluation, what is a prudent process for evaluating these products. Over the past 10 years, we've seen a huge growth in target date fund strategies, and I think it can be tied to two things. One, legislative, which was the passage of the Pension Protection Act in 2006. The other is we've seen, I think a great deal of focus on trying to deliver better outcomes for participants in plans, and one way that every plan sponsor is looking at is how do we cost effectively provide in mass some participant advice. And this kind of goes hand in hand with the Pension Protection Act, which was passed in 2006. And at the time, what the objective was to ensure that an investment qualifying as a QDIA is appropriate as a single investment capable of meeting a worker's long-term retirement savings needs. That's what the Department of Labor's stated objective was. And while it's been a while, if we think back to pre-2006 and pre-PPA, every plan has a default investment. And I think what the Department of Labor was finding was that frequently, because of inertia, participants were using the default investment option and leaving their money in that. Most plans pre-PPA defined risk as variability in the net asset value or the principal value of the investment. So we're using money market or general account or stable value type products as the default investment choice. And the view was they're not going to fluctuate in value, and therefore, participants not going to lose money, and we're protected. The PPA kind of flipped the view of that and said, what needs to be taken into consideration is the fact that these are long-term retirement savings vehicles, and the biggest risk to participants isn't short-term variability in markets, but long-term failure to meet or retirement savings goal. So we need to look at risk in a different way than we have historically. And so the PPA created this concept of a qualified default investment alternative. And what it was to encourage people to move away from these low return, low risk default investment options. We need to provide some safe harbors for plan sponsors so that they feel comfortable that they're not going to run afoul of their participants by making a more prudent decision here. The final regulations outline 4 categories of products that would qualify as a QDIA. The first is a product with a mix of investments that takes into account the individual's age or retirement date. That is target date funds. The second is an investment service that allocates contributions among the existing plan options to provide an asset mix that takes into an individual's age or retirement date. This is most frequently you'll see it referred to as a managed account type solution. The third option is a product that takes into account the characteristics of the group of employees as a whole. And so they're looking at a single balanced fund type strategy or model portfolio, but is prudent for the average participant in the plan. And then the last option is you could use one of these capital preservation products that you've used in the past, but you can only do so for 120 days. And at the end of that period, if the participant hasn't made election, you need to redefault them. So as you look at those options, the last one I think has been kind of determined to be not really a great option because you have to go through this default scenario twice. So that hasn't been heavily utilized. The third option, plan sponsors in some cases do that using a balanced fund. But they still have to look at the age and demographics of their participant population to try and figure out what's appropriate. So it's hard to find one fund that is appropriate for most of your plan participants. Similarly, the second option, we've seen a lot of interest and discussion from vendors around, but as a default investment option, a managed account is not been an ideal choice for most plan sponsors because of the added cost that comes from those services and the fact that most of the value that comes from those products is when participants engage to provide additional demographic information about themselves and their spouse that the model can then customize the recommendation. The first option, the age-based target date fund, is hands down the most common default product that's been adopted by plan sponsors post-PPA. A couple things, though, that are important to consider is that the QDIA regulations created this safe harbor that said if you use this type of investment product, you can't be faulted by your participants if you default them and you provide all the disclosures and regulations. One area that we've seen some confusion, though, is the DOL hasn't given us a blanket pass to say that any type of fund that calls itself a target date fund or is age-based is a prudent choice. You as a plan sponsor still have to do the evaluation work to ensure that these products are prudent and suitable for your participants. They're not saying anything that with an age or retirement date in there is automatically a good fund for your participants to use. And so given this set of regulations that have been around for about a decade now, we've seen a huge growth in target date funds as adopted as the default investment option in plans. If you want more information about the QDIA regulations, there's a link to a white paper where we get into more detail about that. But the advent of PPA and the desire of plan sponsors to provide cost-effective advice solutions to their participants has really spurred pretty significant growth in the target date market. These products have been around now for over 20 years. The first products were launched in 1994, and after a decade of existence, had seen mild adoption across most plans and platforms. At the end of 2003, there were 16 target date fund series in the market. Now there's 43 target date mutual fund series, an additional 50 plus collective investment trust products, an untold number of custom separate accounts and individualized model portfolios. So the investment management industry has looked at the universe and said, these are the default. If we look at where cash flows are going within plans, new cash flows are predominantly being allocated to target date funds. And so if we want to be a investment manager to defined contribution retirement plans, we need to have a target date fund series. That one thing that's important, I guess, or interesting to note is that, well, we're at right now about 43 target date mutual fund series. The market isn't particularly balanced. The chart on the right shows the top 10 providers at the end of 2014. And you can see that the top 3 providers account for about 70% of the assets within these products. So we've seen a rush to introduce product and to try and grab assets in the defined contribution space. It hasn't been widely successful across all the investment managers that have launched these products, and we've actually seen a number of fund managers that launched them that never got traction in the marketplace end up terminating their products. The top 3 providers, Vanguard, which passed Fidelity in the past year, Fidelity number 2, and T. Rowe Price. I think there's a few attributes to them that are unique in understanding why they are positioned where they are in the marketplace. One is that they've been around for a relatively long period of time, so they've had that track record. They're not the oldest target date funds by any means, but they've been around in the market for a while. The second factor, and probably the most important factor, is that they have strong distribution capabilities built in because they're large record-keeping organizations. Fidelity's far and away the #1 record keeper in the market, and for a long time, the strategy, but prior to the PPA, was to add the Freedom Funds as an option within the plan, as an opportunity for participants that don't want to allocate their own funds. Let's add the Freedom Funds, and so early on in their existence, and still true across many plans and platforms, the use of target date investments was driven by the record-keeping platform. So if you're a Vanguard client, you likely have Vanguard's target retirement funds. If you're a Fidelity client or a T. Rowe Price client on the record-keeping side, you likely have their proprietary investment options as well. You can see a pretty significant drop-off from T. Rowe Price, which has about $122 billion in target date investments, down to J.P. Morgan, that's the #4 spot. And then, outside of the top 10, there's 30-plus other options that account for less than 10% of the total assets. So, this is, if you're an investment manager and you want to be successful in growing assets, this is the space that you most likely have to be in and fight with those top providers to gain assets. One thing that has been somewhat interesting, as I mentioned, early on the adoption of these products was kind of an add-on. You may want to offer something to your participants like this. It's no cost to you as the plan sponsor. It gives them an easy choice, and why not add it? The Pension Protection Act created the QDIA, and so you saw more adoption, a little bit more focus. And a couple years ago, I think the Department of Labor realized that the growth in assets in this space was far outpacing the work that was being done by plan sponsors to evaluate them. And so the Department of Labor in 2013 published a relatively brief set of guidance about what plan sponsors should be doing with respect to these target date funds. And I would say most of them are self-evident, but there's a few wrinkles and quirks with this to keep in mind. First, they said, as a plan sponsor or plan fiduciary, you need to establish a process for comparing and selecting your TDFs. It's not suitable to just assume that whatever the proprietary option is with your record keeper is suitable. So show us that you have a process for evaluating these, similar to what most of us as fiduciaries have done with respect to core funds. Demonstrate you have a process for evaluating. Second is establish a process for the periodic review of selecting them. So one, the process of how do we pick our target date fund. Two is what is our process for reviewing those periodically. Third one is understand the fund's investments. What asset classes are they allocated to, what the individual investment options are, and how they will change over time. Fourth is review the fund's fees and investment expenses. Fifth is, and this is where it gets a little bit unique, is inquire about whether a custom or non-proprietary target date fund would be a better fit for your fund. Certainly, I think non-proprietary investment options make a great deal of sense. Just because you're with a Fidelity or a Vanguard or a T. Rowe Price doesn't mean you should have to use their investment product. But where I think it's a little unique and challenging is the idea of whether custom target date funds make sense. And we'll talk a little bit about what a custom target date fund may be and why that may be worthwhile or may be a challenge to you. Next, they said develop effective employee communication around the target date funds. Then take advantage of available sources of information to you to evaluate the TDF recommendations, and lastly, document the process. So the Department of Labor's guidance, I think, in most cases is common sense, and there's nothing really earth-shattering around it, but it does, I guess, indicate some heightened level of interest around these types of products and what you as a fiduciary are doing to evaluate them and demonstrate the prudence of your process. As we look at a prudent method for evaluating target date funds, it really is challenging for most of us that have grown accustomed to evaluating core investment options in our plans. Looking at a core bond fund or a large cap growth strategy or an international equity fund, the typical tools of understanding the manager, looking at performance relative to a benchmark and peer group, and being very quantitative in evaluation isn't sufficient to evaluating target date funds. And that's because there's more moving parts to these products and more complexity. So as we look at it, it's a multi-step process to evaluate target date funds from a selection process. First, we need to understand the investment manager's firm capabilities. Then look at the glide path construction, look at the asset class selection within the glide path, and how they're implementing the underlying investment management. Overlaying all of that is an understanding of the fees and costs that are involved, because a number of the decisions that are made along the way in terms of asset classes and glide path and investment management have a cost factor to them. So we can't ignore costs as we evaluate them, nor can we look solely at costs and say the cheapest product is the best. So start out with understanding what the investment manager firm capabilities are. This is really important because target date funds present a pretty significant shift in responsibilities within a defined contribution plan. Most 401k and 403b and 457 plans have historically allowed participants to allocate amongst a number of different asset class-driven investment options and put the responsibility for portfolio management squarely on the participant to say, here's a bunch of good choices, you pick what's appropriate. The managers that are offered in the platform have responsibilities for, within their asset class, trying to identify stocks or bonds that are going to add value, but they stick really within their niche of whatever the given asset class was. The shift that we're seeing is that asset allocation or portfolio management responsibility that was traditionally with the plan participant is being shifted to the fund manager. And that is, in a lot of ways, different than the expertise that these investment management firms have had historically. They still maintain responsibility for security selection and asset class level portfolio management, but they are now responsible for determining the mix of stocks and bonds and other assets that go into the target date funds. So as we look at pushing more responsibility to the plan sponsor or to the investment manager, I think we need to understand at a deeper level what their capabilities are in this space. And that starts by understanding firm stability, the experience they have, their commitment to the space, the people, processes, and resources that they're committing to managing these funds. So first question is, how stable is the organization? These target date funds are designed to last for at a minimum a participant's working life. We see funds that are labeled 2060 funds now, and frequently are designed to last into retirement, so beyond your whole working life, potentially to death. So our investment horizon in these products is 40 to 70 years in some cases. During that time, I think it's a reasonable expectation that these funds are going to need to grow and adapt to changing market dynamics. New asset classes become available, new research demonstrates better ways to manage risk or achieve better returns, and just general market changes over time will lead us to believe that these products aren't static in their construction. So we're looking for managers that have the stability to last this time horizon and also commit to continuing to evolve these products. Another thing in our experience that we found, and it relates to stability, is the fact that as these funds have become more prominent within the investment menu as a default option, plan sponsors, fiduciaries are more reluctant to see turnover in this space than they are in a core funds. If we have a large cap growth manager that we decide is no longer the best fit there, we can make a switch without much impact on participants. We send them a notice and that switch happens and we don't hear a lot. If the target date funds are being used by a large portion of our population, either because they were defaulted there and stayed there, because they actively decided that this was a good way to manage their portfolio, if we see frequent turnover in the target date fund options within the plan, we are, I think, going to create some concern at the participant level about the stability of the plan and the actions of the plan sponsor. So we want firms that are stable, both because these products are going to evolve and we have a long time horizon, but also because we don't want to see a lot of turnover within the investment menu with these products. The second question is, what experience does the firm have in creating global asset allocation portfolios? Again, most investment management firms have been successful historically because of their single asset class funds. I guess a prime example is Fidelity with Peter Lynch. It's a growth manager that was best known for picking stocks that were going to experience high levels of growth, and that being their niche. Their skill is in evaluating and picking individual stocks or bonds with whatever style and philosophy that they have. As we talked about, this changes what we're expecting of them. So we have to look and say, what experience do they have that's relevant in managing this? I guess the good news is that as the market has matured, they've been able to demonstrate expertise in this asset class. But if they're a newer entrant in the market, we have to look and say, what other capabilities do they have? Maybe they've been investing in target risk strategies for a number of years. Maybe they've done outsourced pension investing, or they have an investment consulting arm within their organization. But we need to evaluate the capabilities they have managing asset allocation portfolios and not just stock funds or bond funds. With that, we also need to understand where the asset allocation work is done. Some outsource this to a third party. I'd say most providers do it internally, but are they doing it within a separate group in their organization, or are they doing this within kind of the product management team? Understanding stability then next gets to commitment. Commitment, does tie into stability. As I mentioned at the outset, we have seen actually in the past few years a bit of a contraction in the marketplace as people have launched products. They've not grown the way they had hoped to, and so they actually liquidate them and pull back. Again, our time horizon is pretty long, and so we want to make sure that the firm is committed to offering these products and continuing to improve them. Things we look at to determine that level of commitment are staffing around these target date funds. Do they have an asset allocation group whose sole responsibility is to manage this? Is it done, again, in product management where they're looking to build something that can be sold? Are they using portfolio managers who have other responsibilities and this is a side job? What's the staffing look like for managing these target date funds? Are they a core product? Again, I think if you were to look at those top 10 providers, they represent, the assets they have in target date funds represent a pretty significant portion of the assets they manage. Certainly a core product. If this is a newer product within your investment tool set as an investment manager, and you haven't seen heavy adoption there, you're probably not as committed to continuing to evolve these products. Similar to that is, has there been enough traction in the market to support long-term viability? Newly launched product could have the best of intentions and have the smartest and best, management philosophy behind it, but if it's not going to gain traction in the marketplace, it's not likely that the firm's going to remain committed to that for indefinite periods of time. And then lastly, from a commitment perspective, is what thought leadership are they putting out there? One way to evaluate these managers is to understand what their philosophy is with respect to managing it. So they should be, on a relatively frequent basis, publishing thought leadership about how they've built their portfolios, the assumptions they use, the modeling they do, and why they think the way that they've built this is prudent. And then the next thing to evaluate is the people. What experience do they have with asset allocation funds? How long have they been managing these products? And what responsibilities do they have within the firm aside from managing these target date funds? That informs us a lot of cases as to the level of commitment that the organization is making with respect to these products, is the experience of the people they have assigned responsibility for these funds. And then looking at the process they have, again, with the assumption that these products will continue to evolve and they're not static, are they reactionary in their approach? We saw pre-2008 a lot of folks look and say, oh, we need more equities in our portfolio. And then we had a 2008 pretty significant downturn in the market, and everybody came back and said, oh, we need to be more conservative. And then we've had a good bull market run, so now equities become more attractive. It's not how we want these products to be managed. We want them to demonstrate their own process for evaluating changes within the target date funds. And then looking within, that, the process for making changes to things like glide path and asset allocation, but then the processes they have for actually managing the funds. How do they handle cash flows? What's their rebalancing process? What happens if there's a manager that within the funds that isn't performing? What are the processes that they use to periodically evaluate changes here? So we take first a look at the investment manager firm capabilities, because ultimately, knowing that these products are going to change and evolve, what we're doing is we're selecting a firm that we want to partner with in offering target date funds. We need to be comfortable with their capabilities and with their philosophy with respect to that. But once we've done that step, the next step is to look at the equity glide path. And what we're talking about here is really the asset allocation at a high level split between stocks and bonds, and how that's going to evolve over time as participants get older and become nearer to the target retirement age. Things for plan fiduciaries to understand or consider are employee demographics, things like average income levels, future wage growth, employee turnover, any existing asset allocations that participants may have, and how that may inform us about their acceptance of investment risk, and their financial literacy. These aren't really binary considerations that point to one type of glide path or another, but they can be used to kind of paint a picture of the types of products that are appropriate for our participants. I would say if we have a population that is generally demonstrated not a great deal of financial literacy, and it tends to be very conservative in their asset allocation based on how they have allocated their existing funds. Offering a very sophisticated, complex investment set with the target date funds probably isn't the most prudent decision to make. And so what are the demographics of the population and how that informs what a prudent glide path is. Other plan design considerations are whether we have a DB plan as well as the DC plan that may cover some or all of our participants, and whether that provides a baseline level of income that can inform how much risk we can take in the DC plan, whether we're using auto-enrollment features and auto-escalation, if there's employer stock in the plan, and the level of employer contributions. If we have a high employer contribution rate, we may not need to take as much investment risk to provide sufficient levels of retirement income for participants. And then the last thing for plan fiduciaries to consider is their own knowledge level and comfort with risk. Because like an individual participant that's allocating their portfolio, if a participant or if a plan fiduciary is picking a target date set of options that they're not comfortable with, either because they don't understand the products or they're taking risks that they're not comfortable with, they're likely to make mistakes in buying high and selling low with the target date funds. So those are internal things that you should be considering. From a fund perspective, understanding the fund sponsor's investment thesis, you'll frequently see discussion around to versus through retirement. We'll talk a little bit about that. Understanding beginning equity levels. So, 40 years from retirement, what is the equity allocation? When does it begin to transition to a more conservative asset allocation? How steeply does it change over time? And at the most conservative equity allocation, one, when does it reach that date? That's the to versus through. Some reach their most conservative point at retirement. Others go beyond that and continue to become more conservative. And what the terminal equity level is. So do we stop at 50% equity, 50% bonds, or do we go to 20% equity, 80% bonds? Those are the things that should be considered from a glide path construction with respect to the individual funds. So to versus through retirement. One of the most hotly contested and debated topics with target date funds. In our mind, it's a little bit overdone. But to think about two retirement funds, we most commonly see there's two investment theses that go into this. The first is a human capital thesis that says investors should have a static risk exposure regardless of their time horizon. Risk isn't really related to time horizon. But as we look, participants' future earnings and Social Security income behave like a bond. They're very steady. There's not a great deal of variability in them year over year. So as an investor ages, their total human capital is a combination of their present value of their future earnings, including Social Security, and the value of their financial assets. Farthest from retirement, they have very high future earnings and no financial assets. So most of their human capital is very conservative. They can take a lot of equity risk in the portfolio with what little financial assets they have. As they get nearer to retirement, the present value of their future earnings decline, and so we need to offset that decline in a bond-like asset by adding bonds to the financial assets. And so that's the argument for gliding down to a more conservative portfolio. At the retirement date, their present value of their future earnings is zero. They have the Social Security, which is going to be fixed, and so we should be at the most conservative point in this person's allocation, and it shouldn't change after that because their future earnings don't change. That's one reason why we see two retirement portfolios. The second is the observed behavior thesis, which says most fund managers create these hypothetical participants that they model and say, this is why our target date fund is the best thing. If you look at this hypothetical participant that does X, Y, and Z, this is what they're going to end up with at retirement. This actually says, the hypothetical isn't the actual, and so we look at participant behavior, and what we see is that participants don't act as the models imply, but tend to take out large withdrawals at or near retirement. There's a great deal of uncertainty around what they're going to do at the end point, and our goal is to get them to that end point. Beyond that retirement date, the participant has to make their own decision. So we're going to get to the most conservative point at retirement, deliver them to that point in time, and then they can go on and do what they want after that date. The impacts of to retirement is that it reaches their most conservative allocation at the retirement date. Because it gets to that at the retirement date, not 5 or 10 or 20 years after that, they tend to have more conservative asset allocations leading up to the retirement date. So for participants in their 50s and early 60s, they tend to have a more conservative allocation than through retirement. These funds also tend to merge at the expected retirement year. So in 2015, if you had a 2015 retirement fund, that fund would tend to be merged into the retirement income fund. Through retirement, on the other hand, looks and says, time horizon is a really important factor, and longevity risk is the biggest risk that participants face. We know that over the longer term, equity risk tends to be minimized because short-term volatility balances out, and even at retirement date, participants have 30 plus years of expected longevity in the extreme end, and so we need to manage for growth to provide sufficient returns to fund a comfortable retirement. They tend to think, these fund managers, that market risk is weighed too heavily as we look at these, and that longevity and inflation are two bigger risks that participants face. And as a result, we tend to see higher equity exposure in these portfolios, both nearing retirement and then into retirement. The impacts, usually we see that funds continue to glide past the retirement date for 5 to 20 plus years. So you will see from some fund families, 2010 funds, 2005 funds, 2000 funds that are past the retirement date but are continuing to get more conservative over time. In contrast to the to retirement, these tend to have higher equities across the spectrum, especially as we are nearing retirement, because they're not getting as conservative as quickly. And also participants maintain those age-specific funds past the retirement date, so there's not as much fund merger activity. I would say in our experience, the to retirement camp has been the most vocal in trying to demonstrate that their method of managing these products is the best way to do it. But in practice, if you look at where the assets are, the market's voted with retirement funds. Both Fidelity, Vanguard, and T. Rowe are all through retirement. You have to get down to number 4, JP Morgan, to find a to retirement provider. Why we think this is a somewhat overrated debate is that it's too binary. There's multiple levels of risk, and a lot of times folks are using the to versus through debate as a proxy for overall risk levels, assuming that all to retirement funds are more conservative than all through retirement funds. We think a more nuanced evaluation is appropriate, and so don't think it's a good idea to simplify this to funds versus through funds, and one is better than the other. Why this matters? If you look at farthest from retirement, where we have the least invested in these funds and the least at stake, we see the greatest consensus as to appropriate allocations. The most conservative end, you see 80% stocks. At the most aggressive end, you see 100% equities. Not a lot of variance. But as we get closer to the retirement date, when we have more money invested, shorter time horizons, and more on the line, we see greater variability in what each investment manager thinks is prudent. The most conservative end, we see 25% stocks for at retirement, up to 78% stocks. So that variability in stock bond allocation is going to have a huge impact on the expectations of participants and what they achieve in expected return, as well as expected risk and the outcomes they have in placing retirement. So when the most is at stake, we have the greatest debate as to what is suitable or prudent from an asset allocation perspective. To understand what the impact of a glide path has on performance, the good news is we have a very notable experience time period here where we can look at this. So looking at the 2008, 2009 bear market and rebound, 2010 funds at the time, one with an aggressive glide path in 2008 was down almost 27%. The more conservative glide path 2010 fund was only down 10.75%. So, two 2010 funds in a bad market environment had a 16% difference in performance. In 2009, as the market recovered, the more aggressive fund was up almost 28%. The more conservative fund was up 12.76. So near retirement, glide path can, at the extremes, have a pretty significant impact on expected return in bear markets as well as bull markets. 2050 funds, which were mostly equities, even in the more conservative glide paths, had a much different, closer performance profile, down 35 and 3/4 to 38 3/4 in 2008, and up 33 to 38, 39% in 2009. So we didn't see the performance differential as much for the more equity-driven portfolios. But glide path can have a pretty significant impact on returns. The next piece, looking firm capabilities and then understanding glide path, is which asset classes then are included. Glide path is really a high-level stock-bond split, but within that, are we providing at a more granular level sufficiently broad exposure to all the different asset classes that are available in capital markets? So understanding which asset classes are included, how did the fund manager determine what was suitable, what modeling have they done, what were their capital market assumptions, are they using historical data to look at how markets have performed and saying that's what we think is going to happen in the future, are they using forecasted data for future returns, and how do they develop that forecasted data, and then what impact do the fund manager's investment products play in determining asset classes? There's a fund manager that just so happened to own a preferred stock provider. Preferred stocks in fund form aren't the most common thing, but not surprisingly, in their modeling, they found that preferred stocks were a great diversifying asset and included them in the portfolio. 2008 financials, preferred stocks tend to be financial companies. Those preferred stocks didn't hold up as well as you thought, but did they include that because they have that capability, or conversely, are they not including assets because they don't have a product to fill that hole? I've seen a manager that never had emerging markets as a standalone strategy for a long time, thought emerging markets weren't necessary in their target date fund. Their firm ended up launching an emerging markets fund, and it just so happens shortly after that they decided emerging markets made sense in the target date fund. What's driving the asset class decisions? And then how are they reviewing that? How frequently are they looking at the structure of investment management? What changes have they made recently? What changes are they evaluating? I think every manager should be always looking at, are there new things that we need to be incorporating into these funds to make them suitable? Most funds have the standard asset classes: cash, intermediate bonds, large cap and small mid-cap U.S. equities, and international equities. We see some other asset classes that get added from time to time, and I would break these into the two camps there. One are the portfolio diversifiers, asset classes that the manager thinks can either enhance returns or reduce risk. Things like stable value, high yield and global bonds, preferred stocks, small cap international, emerging market stocks, some volatility strategies. You might see in custom funds, things like hedge fund or target private equity. And then the second group is real return hedges. Fund managers that are concerned about inflation risk and therefore including things like tips or commodities or real estate or natural resource stocks as a hedge for inflation. Another highlight of how this can have an impact on performance, again using that 2008 environment as kind of a good crucible through which to look at some of these products. We had two funds. Fund A was a 2010 fund that had 42% in Russell 3000 exposure, so that's U.S. equity exposure. Fund B had almost 50% U.S. equity exposure to the Russell 3000. So our traditional glide path only analysis would say Fund B has more stocks, is therefore more risky. But looking through that to look at the asset class level exposures, Fund A had more in bonds, but almost 16% of that was allocated to high yield. High yield bonds in 2008 were down 26%. And the allocation difference between high yield, Fund A had almost 13% more to high yield than Fund B, caused Fund A to underperform Fund B by over 6%. So, looking only at the glide path level would have told us one thing in terms of expectations. Looking at a more granular asset level tells us something else. The next step beyond understanding the firm, the glide path, and the asset allocation or asset class selection is to look at the investment management capabilities. These funds tend to break down into the camp of using either all active investment strategies underneath or all passive. Active, obviously, are seeking to outperform benchmarks, trying to add value through manager skill and timing the market or security selection. They tend to add cost to the portfolio. And so you need to evaluate them on a net of fee basis to determine whether they're adding value to the portfolio. Passive seek to provide market rates of return, generally by replicating benchmark or index returns, and are lower cost and don't have an alpha-seeking component to them. We're seeing the growth a little bit in hybrid strategies where managers may look and say there are certain asset classes, things like large cap U.S. stocks, where we don't think it makes sense to have active management, but we think we have capabilities in these other more niche asset classes, so we'll use active management in some, but not all of the investment mandates within the portfolio. Those can lower total cost, although they don't necessarily do that compared to active funds. Depends on the product structure. So if you're picking funds that use active strategies, you kind of have to do the same stuff you do in evaluating core managers, active managers within your investment menu. Understanding the people, process, investment philosophy, cost, capacity. Active management can add a layer of risk to these funds because of the variability that comes from those active decisions, but it also can enhance returns if done well. If you're using a target date fund strategy that has active management, what is the process for selecting those active managers? How does the target date fund manager evaluate them? And what happens if a manager underperforms? And this gets into some of the issues you have with conflicts of interest, proprietary fund managers that use their own products, and are they doing what's best for participants, or are they doing what's best for the fund manager from a distribution perspective? If you're using a passive target date fund series, you still need to evaluate how they select index managers, the indexes that they're picking to benchmark to, their cost and experience managing indexed assets, the tracking errors that they've demonstrated. And one of the things that tends to happen with index strategies is they have a more limited set of asset class exposures. So do we have enough diversity there in asset class exposure to be prudent in building these products? As we look at active management, it's a high hurdle to clear in terms of adding value. We did a study in early 2015 where we looked at the average performance of the 43 target date fund series with at least 5 years of history. We ran some quantitative analysis to determine investment styles and calculated custom style benchmarks for each of those series. And we compared the fund's returns to that style-based benchmark to see if they were generating alpha. Less than 20% of the target date fund series we evaluated had positive average alpha across their target date fund series. The highest was about 2.64%. On the flip side, over 80% of the managers had negative alpha net of fees. The worst was about 1.5% under the style benchmark per year for the 5 years, and the average was that these managers underperformed. So, alpha providing target date funds that are net of fees adding performance are pretty rare, and it's something to consider as you evaluate your target date funds. It's not that it doesn't exist, but it's not the given that I think a lot of people think it is. Active versus passive is kind of one dimension to look at investment management. The next is proprietary versus open architecture. Most products use proprietary investment management, where all the underlying funds are managed by the same investment manager as the target date fund manager. Again, this can create some perceptions of conflicts about how they pick those underlying managers. And if you have an investment management firm that has a very well-developed and singular philosophy, you may find that across the different asset buckets, investment strategies, there's very consistent correlation in alphas, the types of markets where the manager adds value, so you don't get the diversification benefit that you may have thought you would by having different managers. Open architecture, there's a fund, target date fund manager or sponsor. They utilize outside portfolio managers for the individual sleeves or buckets within the target date portfolio. They're not very common in the mutual fund environment. You do see more of them in collectives, as well as folks building custom target date fund strategies. The challenge with them is that it adds a layer of fees because you have the fund sponsor at the target date level, and then you have the underlying managers that all want their own fee. And open architecture hasn't necessarily led to better performance. So just because you eliminate some of the biases that proprietary funds have doesn't guarantee that you're going to have better returns. And in some cases, it makes it more difficult to manage the target date funds if the manager is looking to use something like a tactical tilts or management of the overall portfolio. Then you see some that are hybrid strategies where it's a combination of proprietary as well as outside portfolio managers. In some cases where the fund sponsor, the target date fund, doesn't have all of the capabilities in-house. Overlaying all of that, we have to consider costs. I think everybody realizes higher costs create a headwind for investors, a pretty significant drag over time. There tends to be a trade-off within target date funds. Equities usually are more expensive than fixed income. So as we look at glide path, is that increasing costs? Some of the more niche esoteric asset classes can also add fees. If you add a preferred stock or emerging markets or high yield, those strategies tend to add cost to the products. And same with active management. So across all of those, we need to evaluate the impacts that those decisions have, both just with the product in general, but also the cost impact that may have on the portfolios. From an ongoing perspective, the ongoing monitoring is really similar to the selection process, but really looking at stepping back and saying, has anything changed about our initial analysis? The firm changed? Has the product structure changed? Have our demographics changed? Is there anything that leads us to have to re-look at this and go through this selection process again? If nothing's changed, looking just at the performance of the portfolios, is the fund behaving consistent with the expectations given the market environment? Going back to that 2008-2009 time period, if we had an aggressive glide path, we should have expected the fund to have some performance issues in 2008. And if we saw that, it doesn't necessarily raise an alarm. But in 2009, when we saw the market recover and most equities do very well, if the target date funds didn't similarly recover, that would raise a flag. Conversely, if our target date funds were conservative in glide path and asset allocation and didn't do well on a relative basis in 2008, that would be a flag to look at. Then if we're looking at actively managed products, how are the portfolio managers doing in adding value? Are there any concerns there? And then lastly, just looking at how the products compare to other alternatives in the marketplace, knowing that it's not a very homogeneous group. There's a lot of differences that can drive performance. But are there other funds out there that are doing things that may be more appropriate for our participant population? we're coming up on the end of our time here. The last slide I wanted to just quickly go through and then take any questions that anybody might have. There's the 5 things that every plan sponsor I think needs to know about. And the first is, how capable is my firm, target date fund management firm, managing these? Having a strong understanding of kind of the qualitative factors that go into that is critical in making a prudent decision. 2 is the equity glide path consistent with our investment objectives and our demographics. 3 is what asset classes are included in our target date fund. 4 is, how is the portfolio management implemented, and 5 is, how much do our target date funds cost? If you can't answer those questions as a plan fiduciary, I think it makes sense to go back and go through an evaluation process. I think those questions are consistent with what the Department of Labor has outlined as their guidance, and in our experience are prudent, are the questions that plan sponsors should be asking with regard to their target date funds. These funds are, in many cases, capturing the bulk of asset flows within plans, and depending on when you added them and how you've added them, we've seen adoption rates upwards of 75% of plan assets. So committees that are charged with evaluating the investment options within their plan need to reorient to spending more time on these types of products and less time potentially on the small cap growth fund that has 0.5% of assets but has performance that's done really well or is struggling. This is where the bulk of assets are ending up in plans, and plan sponsors need to be able to demonstrate the prudence in the process for selecting and monitoring these funds. With that, those are the slides and the presentation that we had. Certainly happy to answer any questions if people want to submit those on the GoToWebinar panel. If there are no questions, I want to thank everybody again for taking the time to join us today. We're certainly accessible if something comes to mind later that you had about the presentation or about the target date funds that you're using in your plan. And again, we'll send out a copy of the slide deck as well as a link to the recording later this week or early next week. I'm not seeing any questions that I don't believe have been addressed. So I'm going to go ahead and end the presentation now. Thank you again.